The process of creating a formal plan and translating goals into a quantitative format is budgeting. There is no question. It's budgeting. See, activity-based costing, it's a costing system in which we use activities and different cost pools. Job order costing is a costing system we use for those items which can be specifically identified. Customer-driven production and variance analysis is totally different thing. It's a comparison between what we thought we will do versus what we actually did. So basically actual versus the budgeted numbers. So C is the right answer. Which of the following items should be done first when developing a comprehensive budget for a manufacturing company? What you should do first? Determination of advertisement budget, that should come before we plan our sales. So this is not the first thing we do. Yes, development of sales budget, this should come first. Determination of equipment acquisition, this is basically capital budgeting, and it is not done every time at the beginning. It's done for 5 or 10 years into the future. Not correct. Preparation of pro forma income statement will come once you have the budgeted sales. So the correct option is option B. Which of the following is a disadvantage of a participative budgeting? It is more time consuming. That is correct. It is time consuming because it requires input from different departments, different stakeholders, and that's why it causes more time than the other traditional budgeting. So this is correct. It decreases motivation. Wrong. In fact, it increases motivation. It decreases acceptance. Wrong. It increases acceptance because the individuals are themselves involved for whom the budgets are prepared. They are the one who give input. So this is incorrect. It is less accurate. I believe it is more accurate because individuals most responsible for the details of the operation, they are in this process. So this is incorrect. I would say it is more accurate. Which of the following listing correctly describes the order in which the 4 types of budgets must be prepared? Production, makes sense, yes. Direct material purchase, yes. Once production is drawn up, then you make direct material purchase. Sales, wrong. This should be the first one. Reject A. Sales, yes. Production, yes. Direct material and cash investment. This is absolutely right. This is the correct chronological order in which the budgets are prepared. Cash disbursement is the last one. Sales the first. So it's totally in opposite direction. Sales, yes. Direct material comes after production. This is incorrect. Without doubt, B is the right option. Individual budget schedules are prepared to develop an annual comprehensive budget, or also called the master budget. The budget schedule that would provide the necessary input for the direct labor budget would be. Remember, sales is the first budget. After that, we draw a production budget. From production budget, we draw 3 budgets. That is the direct labor budget, direct material purchase budget, and the manufacturing overhead budget. So it says that direct labor budget can be prepared after sales. No, immediately after production budget. That is the correct option. Look no further. D. The cash budget is a useful tool in the planning process. Which of the following is not true statement relating to the preparation of cash budget? The cash budget is usually broken down into monthly period. This is absolutely right statement, correct statement. The cash budget shows itemized cash receipts and disbursements during the period, including the financing activities and the beginning and ending cash balance. That is true as well. The cash budget is typically done before all other budgets. This is wrong. Cash budget is the one that is prepared at the last. Remember, in the budgeting, I'm sure you would remember from our overview class, the sales budget is the first budget and the cash budget is the last budget we draw up. So this is wrong, absolutely wrong. The cash budget alerts management to periods when there will be excess cash available for investment. That's absolutely true. So C is the option that is not true and is our right answer. Fargo Manufacturing, a small business, is developing a budget for the next year. Which of the following steps should Fargo perform first? First, sales volume. Production comes later. Identifying cost comes later. Compute the dollar amount of Fargo's forecast sales. You need the quantity first and then you can multiply the quantity with the budgeted selling price. So this is, of course, both are sales, but this is in the sales dollar, this is sales volume. This is what you forecast first. So A is the right option. Which of the following types of budgets is the last budget to be produced during the budgeting process? Cash budget. We've just discussed that. There are various budgets within the master budget cycle. One of these budgets is the production budget. Which of the following best describes the production budget? I'm sure you would remember. Production budget can be drawn up from three inputs: planned sales or your budgeted sales. Planned sales or budgeted sales. To this we add our desired closing stock of finished goods and minus our opening stock of finished goods. That's all. It includes direct labor hours? No. It includes required material purchase? No. That is actually the direct material purchase budget. It is drawn up once the production budget has been drawn up. It aggregates the monetary details of the operating budget? No. It just requires you to find first the budgeted sales, desired closing stock minus opening stock. It is calculated from the desired ending inventory and the sales forecast. At least two of the elements are available. We need the opening stock also to make it a completely 100% correct description. Nonetheless, D is the best one amongst all. Right answer, D. The basic difference between master budget and the flexible budget is that master budget is based on a specific level of production and sales, and flexible budget can be prepared for any production level, but within the relevant range. That is correct option. Absolutely right. Why not B? Master budget is only used before and during the budget period, and flexible budget is only used after the budget period. Wrong. Flexible budget is used before and during the period. This statement is incorrect. Based on a fixed standard, whereas a flexible budget allows management latitude in meeting the goals. This is again incorrect. Flexible budget is based on fixed standards which are appropriately flexed according to the actual level of output achieved or the level of output that we are likely to achieve. Incorrect. Why not D? Master budget is for an entire production facility, whereas flexible budget is applicable to a single department only. This is again wrong. Flexible budget is developed for a single department and for the production facility as a whole, not just for a single department. A static budget contains which of the following amounts? Let me show you what you covered in the overview class. Static budget, original standard quantity into the standard price, but our actual numbers would be based upon the actual quantity into actual price. Maybe we would have set up a budget for 10,000 units, but actually we ended up selling 8,000 units, so we can't compare them. But if we do, the variance you will get is called the static budget variance, which has a very limited application for us. So what we will have to do, we will have to revise our budget based upon the actual activity attained. So it's going to be actual quantity from the actual results, that is the AQ, multiplied by the standard price taken from the static budget. Now this is much more meaningful comparison. We are comparing an 8,000 units budget with the 8,000 actual results. This comparison will reveal a very useful budget variance. That's what we call the flexible budget variance for sales and for your costs. And if we make a comparison between the static budget and the flexible budget, this is called the volume variance. We have discussed this in detail in our overview class. Now the question says, a static budget contains which of the following? Standard quantities and standard price, or in other words, the budgeted costs and budgeted outputs. SQAP. Budgeted output means the standard quantity and budgeted cost, that is the standard price, right? What about the flexible budget? Flexible budget contains the actual quantity and the standard price. Standard price means the budgeted costs and the actual output. That is the flex budget. And in actual results, of course, you have the actual costs and the actual output, that is AQ. So this is our answer. Static budget contains the budgeted cost and the budgeted output, which you call the standard price and standard quantity. D is the right option. Organic Enterprises cultivates potted plants and hybrids. Management conducted a careful engineering study of the product requirements and has developed standards to control production. Standards of this type are also referred to as, since the management has conducted the studies and management has set the standards, They're called authoritative standards. A is the right option. Why not B? Participative standards. We don't see any participation. Standards imposed by the management without employees' input and involvement. So employees' involvement will result in participative standards, which is not the case right here. Ideal standards. Ideal standards are basically based upon optimum conditions when the plant works non-stop. There are no glitches, no production stoppages. We don't normally maintain this level of productivity in the long run, so this is incorrect. Attainable standards. Again, attainable standards are what are practically possible. They assume normal conditions, downtime, material or labor unavailability, strikes, etc. What we can do. They are normally called practical standards. So they are less than the optimal conditions, or less than normal, or less than ideal, of course. Okay, now this is a good one. Daffy Tunes manufactures an animated rabbit with moving parts and a built-in voice box. Projected sales in units for the next 5 months are as follows. Jan, Feb, March, April and May. This is the plans or projected sales or budgeted sales. Each rabbit requires basic materials that Daffy purchases from a single supplier. Let us first see what exactly is required. We need the unit production budget for animated rabbits for January. So you just need to find out the units to be produced. For that, you need to have the planned sales, which we have. To this, we add the desired closing stock and we deduct the opening stock, and you will be able to drop your production budget. So just look for the numbers we need for production. It says Daffy policies to manufacture 1.5 times the coming month's projected sales every other month, starting with January. That is the odd numbered months for February sales, and to manufacture 0.5 times the coming month's projected sales in the alternative months, that is even number months. Now let me first explain what actually this means. This question is there in CMA, also done it hundreds times. Jan, Feb, March, April and May. Jan is the odd number month, even, odd, odd. The company's policy is to manufacture 1.5 times the coming month's sales in the odd months. So what we are going to do, we are going to produce 1.5 times of the sales expected in Feb. Why? Because Jan is an odd month. What we will do in Feb we will produce 0.5 times of the expected sales in March. Because it's an even month. Then what you will do in March you will produce 1.5 times of the anticipated sales in April. So in every odd month, we produce 1.5 times of the next month's sales, and in every even month, we produce 0.5 times of the next month's sales, right? Following that policy, we don't need the closing and opening stock. The policy is pretty straightforward. So what do you expect to sell in February? 36,000. Then what you need to produce in Jan? 1.5 times of Feb sales. So 36,000 times 1.5 will give you 54,000, and that would be C. But still we haven't answered the essence of this question. Why the firm would do that? Why? 1.5, 0.5, 1.5, 0.5. This allows Daffy to allocate limited manufacturing resources to other products as needed during the even numbered months. So since during the even number month, we will only produce 0.5 times of next month's sales, so we will have some productive capacity available which we might use elsewhere for our other products. So now we know. Benchmarking compares the current performance of operations to which of the following factors related to competing organization? Standard cost of developing performance measure. This is incorrect because benchmarking does not involve standard cost of developing performance measure. It simply involves a company comparing what it is doing to what other companies are currently doing. So it's we versus them. So this is not right. B, current performance measures. That is true. Benchmarking is basically comparing your current performances with those of the other firms in the current time. So what other companies are doing and how we are doing, comparing their performances, their levels of performance with our, do we perform in the same way, at the same level, or do we exceed them? So this is correct option. Prior performance measures, this is again incorrect because benchmarking evaluates current performance measures, not past performances. And what about D? Anticipated future performance measures. Again, this is incorrect because actual act of benchmarking is based on evaluating the current performance measures of your competing organization, not what they will do in the future. So this is incorrect as well. The best basis upon which cost standards should be set to measure a controllable production inefficiencies is the normal capacity. No, because normal capacity is something that you ordinarily achieve. So if setting your standard at normal capacity will be pretty inefficiency, I would say. Pretty inefficient. Recent average historical performance, again, historical performance may be poor. So why would you set a poor performance standard? Wrong. Yes, engineering standards based on attainable performance. That makes much better sense. The best basis for setting standards is engineering standards based on attainable performance, right? So standards have to be tight. Tight standards are good. But if unattainable, employees will not be able to do it and they might feel demotivated. So this is the correct option. Engineering standard based on the attainable performance. Practical capacity is close to what we can attain, but maybe too low to serve as a tight standard for the employees to feel motivated or feel charged to. Companies in what type of industry may use a standard cost system for cost control? Standard costing is for everybody, for production and for service. So do not just limit the use of standard costing. It's quite extensively used in service industry as well. Which of the following statements regarding selling and administrative budget is most accurate? Selling and administrative budgets are fixed in nature. No, some of them are variable also, like sales commission is a selling expense and it's variable dependent upon sales. Selling and administrative budgets are difficult to allocate by month and are best presented as one number for the entire year. Wrong. In fact, selling and admin budget can be split on monthly basis and they are done on monthly basis. This is incorrect. Selling and admin budgets should be certain percentage of sales and should be developed using the bottom-up approach. Well, this is incorrect. Percentage of sale doesn't make sense because administrative budget are more or less fixed. Your admin staff salary, head office upkeep cost, depreciation of head office equipments. So it tends to be a more in fixed nature. So we can't take it as a percentage of sale. This is inappropriate. C is incorrect as well. What about D? Selling and admin budgets need to be detailed, broken down on fixed and variable parts in order that the key assumptions can be better understood, that how the cost vary. This is the right option, right? Selling and admin budgets need to be detailed in order that the key assumptions are better understood. The right option. The first step in the sales planning process is to assemble all the data that are relevant in developing a comprehensive sales plan. It looks quite appealing, but this is not the right option. Why? The reason is that you cannot assemble the needed data until you know what data is needed. Furthermore, until responsibilities are assigned, it is not clear who will gather what data. So this is not right. Develop management guidelines. That's what you need first. Develop management guidelines specific to sales planning, including the sales planning process and the planning responsibilities. This is the first step. That will come later. What exactly do we need? Why not C? Prepare a sales forecast consistent with specified forecasting guidelines, including assumptions. So this is what you need to get first. Sales forecast will come later, right? So this is again incorrect. D. Applying management evaluation and judgment to develop a comprehensive sales plan. Management cannot judge. Management cannot evaluate the plan unless the guidelines for the plan have been developed first. This is something that you need to develop first. The information contained in a cost of goods manufactured budget would most directly relate to. I'm sure you would know from our overview class. You need the material, you need the direct labor, the overhead, and the work in process inventories change over the period. So it's basically direct material to be used, direct labor, applied manufacturing overhead. This will give you what you call the total manufacturing cost, and then that needs to be adjusted for desired closing stock of work in process minus opening stock of work in process. This will give you the budgeted or the planned cost of goods manufactured. This is pretty straightforward. Those who have attended the class related to the overview of this unit, they would know. Look no further. This is the correct option. Which of the following options lists the correct sequence of preparing budgets? Cost of goods sold, sales budget. Wrong. Sales budget should come first. Material purchase budget comes after the production budget is drawn. Incorrect, incorrect. Sales budget, yes. Production budget, yes. Budgeted balance sheet, no. It comes after the income statement. Incorrect. Production budget, yes. After production budget, we can draw three budgets simultaneously: direct labor, direct material, and manufacturing overhead. And it makes perfect sense. Direct materials here. Budgeted income statement, and then finally budgeted balance sheet. These are all in the correct chronological order. Look no further. D is the right option. What is required unit production level given the following factors? Projected sales, beginning inventory, ending inventory, desired, and prior year's beginning inventory. Listen, I'm sure you will remember, if you need to draw up your production budget, you need planned sales. To that, you add up your desired closing stock and deduct your beginning inventory. What about this? Prior year beginning inventory. This is the inventory about a year ago or a period ago. We are least interested. Remember, I hope you remember from our overview class, you need planned sales. To that, you add your desired closing stock and deduct opening stock, and you'll get your answer. So it's going to be 1000 plus 100 less 85 gives you 1015. That makes B to be the correct option. Grant Company sales budget shows the following projections for the year ended December 31st. First quarter, second quarter, third, fourth, for the whole next year. Inventory at the beginning of the year was budgeted 9,000 units. That's the opening stock of finished goods, remember. The quantity of finished goods inventory at the end of each quarter is equal to 30% of the next quarter's budgeted sales of the units. What amount should the production budget show for the unit to be produced during the first quarter? I told you, I hope you would remember. You need the first quarter, quarter one, you need the second quarter, and if possible, the previous quarter. We don't have the previous quarter, so this is the format you will use. Planned sales. To this, you add your desired closing stock and deduct the opening stock. So what's the planned sales for quarter one? 30,000 units. What is the planned sales for quarter two? 40,000 units. As per the policy, our closing stock should be equal to 30% of next quarter's sales. So 30% of 40,000 would be 12,000. And from this, we deduct the opening stock, which is already given as 9,000. Just net these off and you'll get your answer. And I believe it's going to be 42 less 9, 33,000. B is the answer. Use this format. You can solve any question on the face of this planet. We have used this method solving hundreds of questions in your CMA and CPA as well as ACCA. So it will be little time consuming in the beginning when you're practicing. Once you learn how to lay out the numbers, you can find the results quite quickly. What do we need to do? How many pounds of raw material should Johnson budget to purchase for January? I told you, in order to draw the production budget, you need sales, and for direct material purchase budget, you need production. So production is already there. Production is already there for Jan. So what you're going to do, Jan, Feb, and ideally you should have December, but if you have the opening stock of raw material, opening plan, then things are fine. Let us see. What do we plan to produce in Jan? 12,000 units. What do we want to produce in Feb? 11,000 units. Based upon our planned production, we need 4 pounds of raw material for every completed unit. So which means we would be requiring 48,000 pounds of material for Jan and 44,000 pounds of material in Feb. Remember, this is not your answer. Do not go for C. This is wrong. This is the material needed for production. This is not what you're going to purchase. There is a hell of difference between the material needed for production, 48,000 for Jan, and the material that you need to purchase. right? You have to follow the policy. So this is the what you call the material required for production. We need to add the desired closing stock of raw material as per the policy. John's policy is to have sufficient raw material on hand at the end of each month for 40% of the following month's production requirement. Our closing stock of raw material must be equal to 40% of the next month's material requirement. So my closing stock in Jan is going to be 40% of 44,000 pounds, that is 17,600. And from this I need to deduct the opening stock of raw material, which I think I should have. If not, we can just work it out. What would be our closing stock in December? Closing stock in December is going to be 40% of January's production requirement. 48,000 pounds needed in January. 40% of this should be available at the end of December. And this is going to be your opening stock, because December's closing stock is your opening stock. Just net these off and you'll get your right answer. 48,000, 17,600 less 19,200. You get 46,400. That is the right option. That is the right option. Please do not confuse. This 48,000 is the material required for production in January. And what we got now, this is the material you need to purchase in January in order to maintain your closing stocks of raw materials requirement. Okay, now this appears to be a different question than the previous one. Here we are talking about a retailing business. You are not a manufacturer. You just purchase and sell. So the idea is the same. A company has budgeted sales for Jan and Feb of 20,000 units to be sold in Jan and 25,000 units in Feb. The selling price is 5 per unit and the purchase price is 3 per unit. Budgeted ending inventory is 10% of the next month's sales. So this is the planned sales. To this we add the desired closing stock, which happens to be 10% of next month's sales. So in Jan, what would be our closing stock? 10% of the Feb sale, right? And what would be the opening stock in Jan? That's going to be 10% of the Jan sales, that is 2,000. Jan's 20,000 sales, 10% would be the closing stock in December, and this happens to be the opening stock in January. So it's going to be 20,500. These are the units we need to purchase each. So this is the price at which we will sell. This is the price at which we will buy. So it's just 20,500 times 3. It is 61,500. That makes C to be the correct option. For the month of December, Crystal Clear Bottling expects to sell 12,500 cases of cranberry sparkling water at 24.8 per case and 33,100 cases of lemon dream cola at 32 per case. That's the planned sales. Sales personnel, let us write this down in a proper format. Cranberry sparkling water, we expect to sell 12,500 at the rate of 24.8 per case. And for lemon dream cola, we are expecting to sell 33,100 cases at the rate of $32 per case. So our planned sales, 12,500 times 24.8 is 310. Let us read the other information and then see what exactly we need to do. Sales personnel receive 6% commission on each case of cranberry sparkling water and 8% commission on each case of lemon dream cola. In order to receive a commission on product, the sales personnel team must meet the individual product revenue quota. The sales quota for cranberry sparkling water is at least $500,000. That's the standard you need to attain in order to be entitled to receive commission. And sales quota for lemon dream cola is 1 million. Okay. Sales commission that should be budgeted for December. Let us see, 12,500 is what we plan to sell at 24.8. So it's just 310, which means we will not be able to attain the target. So no commission here. What about 33,100 LDC lemon dream cola times 32? Yes, it's going to be 105,9,200 above the target. So you must calculate 8% of this number as your commission, which comes out to be 84,736. So that makes C to be the correct option. What do we need? How much raw material should Jordan Auto purchase in March? We have developed the following production plan for Jan, Feb and March and April. Each unit contains 3 pounds of raw material. That's an important information. The desired raw material in ending inventory each month is 120% of the next month's production requirement plus 500. The beginning inventory meets this requirement. Jordan Auto has developed the following direct labor standard, which is not needed. We just need to see how many pounds do we need to purchase in March. So I've always recommended to take the March month, take 1 month forward, which is April, and 1 month back, that is Feb, right? So you write here planned production or budgeted production. For Feb, it's 8,000. For March, it is 9,000. For April, it is 12,000, right? So material needed for production, it takes 3 pounds for each. That's 24,000 pounds needed in Feb, 27,000 needed in March, and 36,000 pounds needed in April. This is the material needed for production. So do not jump for March and do not go for 27,000 if it's given. The right approach is to first calculate the desired closing stock of raw material. As per the policy, the closing stock should be equal to 120% of the next month's requirement, 27,000, 1.2 times plus 500 for the additional material to be held as per the policy. So the closing stock in Feb is going to be 32,900. The closing stock in March is going to be 36,000 times 1.2 plus 500. It is 43,700. Don't do anything else. Opening stock in March is the closing stock in Feb. That's why I prefer this method, 32,900. All the numbers are clearly, nicely laid down, and you're very less likely to make any mistake. 27,000 plus 43,700 less 32,900, and you get 37,800, and that's going to be 37,800 pounds needed to be purchased in March. That makes C to be the correct option. Remember, 27,000 pound is the material needed to produce the planned production in March. 37,800 is to be purchased in order to meet the company's policy for raw material. C is the answer. Okay, Rocket Corporation is a manufacturer of tables sold to schools, restaurants, hotels, and other institutions. The tabletops manufactured by Rocket, but the legs are purchased from an outside supplier. The assembly department takes a manufactured tabletop and attaches the 4 purchased table legs. It takes 20 minutes for labor to assemble a table. The company follows a policy of producing enough tables to ensure 40% of next month's sales are in the finished goods inventory. So closing stock of finished goods must be equal to 40% of the next month's planned sales. That's an important information. Rocket also purchases sufficient raw material to ensure that the raw material inventory is 60% of the following month's scheduled production. These are 2 separate policies, one for the finished goods, other for the raw material. Right here, we are looking for the finished goods only, so we will be interested only this part. So what is the planned production or the production level we should maintain in August? I told you August, 1 month forward, that's September, 1 month back, that's July. You start with the planned sales. Planned sales for July 2,300, August 2,500, and for September 2,100. To this we add the desired closing stock, which as per the company's policy is 40% of the next month's sales. 2,500's 40% will give you 1,000. And 2,100's 40%, that is the closing stock for August. So it's going to be 2,100 times 40%, 840. Don't do anything else. Opening stock needs to be deducted, and opening stock in August will be the closing stock in July. I recommend this approach because we have solved hundreds of questions. All these questions we are doing right here, all of them are from CMA. So BEC is hardly 10% of your entire CMA. So whatever you're doing, every question is from CMA part 1, section B, budgeting. So if you simplify, 2,500 plus 840 less 1,000, 2,340, that's the planned production for August. So that perfectly matches with your option A. Jack Company plans to produce 200,000 pairs of roller skates during January of next year. Planned production for February is this much. So Jan and Feb, planned production is given. Planned production for Jan is 200,000 pairs. For Feb, it's going to be 250,000 pairs. Sales are forecast at 180 pair for January and 240 pairs for Feb. That's the planned sales. Above is the planned production. What exactly do we need? Each pair of roller skates has 8 wheels. Jack policy is to maintain 10% of the next month's production in inventory at the end of the month. How many wheels should Jack purchase during January? So you need to, first of all, you need 8 wheels for each finished units, which means our material needed for production is 1.6 million wheels for Jan production and 2 million wheels for Feb production. Remember, this is the material needed for production. To this we add the desired closing stock as per the policy. It says that your closing stock of raw materials, in this case wheels, 10% of the next month's production inventory. So we need 2 million wheels next month in Feb. We need to have 10% of this in our closing stock. That means we should have this much in the closing stock in Jan. And what would be the opening stock? Clearly, opening stock would be 10% of this number, that's 160. So just net these off and you will get your numbers for Jan. So it's 1.6 million plus 200,000 less 160, and that gives you 1640. That's D. D is the right option. Estimated sales for Johnson Company in the second quarter are shown as follows. April, May, June. Johnson has a policy of maintaining 40% of the following month's estimated cost of sales on hand in the merchandise inventory at the end of each month. The cost of goods sold is 60% of sales. What is the cost of merchandise inventory Johnson needs to purchase in May? I told you May, 1 month forward, June and 1 month backward, April, all given. So we have been given sales and all at selling price. We don't purchase at this price. So we are going to take sales at the cost price, which is 80% of 60% of this number given right here. So it's going to be 70,000 times 60%. $42,000 is the cost price of April sales. 40,000 for 60%, 24,000 for May, and 300,000 for our desired closing stock has to be, as per the policy, 40% of the next month's estimated cost of sales. So it's going to be closing stock 40% of 24,000, that is going to be 9,600. Your closing stock in May is going to be 40% of June's cost of sale, that is 12,000, and that's all. Opening stock in May will be the closing stock in April, and just net these off and you'll get your answer. 24,000. To that you add 12,000, deduct 9,600. You get 26,400, that's C. 26,400 is what you need to purchase in the month of May, and that matches perfectly with your option C. We have done this question earlier, but this time we need to find something else. It says, assume Rocket Corporation will produce 1800 units in the month of September, year 5. How many employees will be required for the assembly department? Fractional employees are acceptable since the employee can be hired on part-time basis. Assume 40 hours week and a 4 weeks month. Okay. Now, if this is the case, we need to produce 1800 units, and each unit requires, I'm sure you would remember, 20 minutes of labor. Meaning thereby 1800 units to be prepared or to be manufactured requiring 20 minutes each. 1800 multiplied by 20. So you need 36,000 minutes of labor effort. If you divide it on 60 minutes, that will give you the hours needed. You need 600 labor hours. 600 labor hours. That means every worker provides you 40 hours each week. For 4 weeks, you can get 160 hours from single worker, 160 labor hours from a single worker. If you need these many labor hours in a month, and this is what each worker can provide, so dividing 600 with 160 will give you 3.75. So that means you need 3 full-time and 0.75 will come from a part-time employee. That makes B to be the correct option. What amount is the total direct material purchase? Direct material purchase comes from production. Let's see. Do we have production numbers? No, we don't have. So first we need to find the production budget, and it comes from the planned sales. To that planned sales, we add our desired ending stock of finished goods, and from this we deduct the opening stock. So take sales, add the desired closing stock of finished goods, deduct this. This will give us the planned production. So it's going to be 14,500 plus 3,000 less 1,500. As per the format. So we need to produce 16,000 units, and each unit requiring how many pounds or kgs. Have we been given the information? No, we have been just given the price. That will make things much easier. Multiplied by 5, that means we need $80,000 worth of material to produce, but we also have some closing stock requirements to fulfill. So this is the planned sales. To this we added the desired closing stock and deducted the opening stock. That's what we need to produce. And the material on this production unit is 80,000. Now we need to add the closing stock of raw material, desired closing stock, and we need to deduct the opening stock of raw material. So closing stock of raw material is 1500 units, each at the rate of 5. That gives you 1500 multiplied by 5. That is 7500. That is to be added. And 2000 multiplied by 5. That is 10,000 needed to be deducted. So material needed for production at the price, add the desired closing stock of raw material in price in dollars, and deduct the opening stock. You should get your answer. And if you do, it's going to be $77,500. $77,500, and that makes C to be the correct option. Oh, this is a good one, a classic question. CRISPR Incorporated plans to sell 80,000 bags of potato chips in June. That's the planned sales. Remember, P sales, planned sales. And each of these bags requires 5 potatoes. Pertinent data includes bags of potato chips, opening stock, and the desired closing stock. And the potatoes, 27,000 potatoes opening, and 23,000 is the desired number of potatoes at the end of the period. What number of units of raw material should CRISPR plan to purchase? You cannot directly draw up the purchase budget before you know what you need to produce. How do you draw up the production budget? The production budget, P budget, is equal to planned sales, 80,000. To this, add the desired closing stock and deduct the opening stock. This will give you the planned production or the production budget. So 80,000 plus 18 less 15. That means you need to produce 83,000 bags of potato chips. 83,000. Now we need to find out the planned production budget already calculated. We need to find how much potatoes do we need to produce. 83,000 bags. Each bag requires 5 potatoes, right? As per the information given. So 83,000 multiplied by 5 gives you 415,000 potatoes. These are the potatoes needed for production. This is not the right answer. You can't see, you can't match this number here. These are the potatoes required for production. We need to meet these stocks requirement also. So closing stock of potatoes desired is 23,000 and opening stock is given as 27,000. And if you simplify, it's going to be 4 and 5 plus 23 less 27. It's going to be 411. These are the potatoes that you need to purchase. C. Jordan Autos has developed the following production plan for the coming 5 months. Each unit contains 3 pounds of raw material. But let's see, what do we need? Direct labor for February. That's all you need. Don't go for material price or all that. Just take what you need to produce in February. We need to produce 8,000 units in February. And it says that there are 2 departments. Department 1, Department 2. If you want to produce 8,000 units, they should go, both of these units should go to Department 1 and 2. In Department 1, you would require 8,000 times 2, 16,000 labor hours. And in Department 2, you would require 8,000 times 0.5, 4,000 labor hours. Each hour at the rate of, in Department 1 is paid at the rate of 6.75. And each hour is paid at the rate of 12 in Department 2. So if you multiply 16,000 times 6.5, that will give you the estimated labor cost for Department 1. And to this add 4,000 labor hours required in Department 2. Each hour in Department 2 is paid at the rate of 12. So that gives you a total of 156. So your total labor cost estimated budgeted for the month of Feb is going to be 156,000. It was a fairly straightforward question. It is always recommended that you need to see the requirement first and then accordingly do what you're planning to do. Okay, now this is what we have already done, but this time we need something else. The dollar production budget for animated rabbits for February is, I hope you would remember, in February, what you will produce, since it's an even number month, so we will produce just 50% of the planned sales in March. The planned sales in March in 33,000, 50% or 0.5 times of this would be 16,500. This is the production in February, right? Now we need to find out the full production cost, direct material, direct labor, variable overheads and fixed overheads. That's what you need in order to find the full cost of production for February. Dollar production budget for animated rabbit. Here it is. It says that direct material is purchased from a single supplier at the rate of 3.5 per rabbit. Vice boxes are purchased from another supplier at 1. So the material cost is 3.5 plus 1, 4.5. It further says assembly rabbit cost $2 per rabbit. $2 per rabbit. It further says that variable overhead is 0.5 per rabbit. See, things are falling in place themselves. And fixed overhead is applied at the rate of $12,000 per month. Keep it aside as a single amount. So simplify these two and these three and multiply with 16,500. 4.5 plus 1 plus 2 plus 0.5 multiplied by 16,500. This gives you 115,500. This is the variable cost of production of direct material, labor and overhead. And to this add the fixed cost of $12,000. Full cost of production will be 127,500, and it should match with any of these options given below. Yes, D is the right option. Now we have got a bigger question. So as I said, you need to look at the requirement first and then you need to see what we can do with this question. The question says the budgeted dollar value of fleet company's purchase of component A19 for the fiscal year ended June 30th, year 2. A19, direct material purchase budget. The problem is we cannot directly draw up the purchase budget until we have the production budget, and production budget cannot be drawn unless we have the sales budget, right? So we need to start from sales. I think it's given right here. Projected sales for tricycles and bicycles. This will help us draw up our production budget, and for production budget we will get to know what is the purchase budget for item A19. So let's start. Let's read the question first. Wellfleet Company manufactures recreational equipment and prepares annual operational budgets for each department. The purchasing department is finalizing plans for the fiscal year ending June 30th, year 2, and has gathered the following information regarding two of the components used in both tricycles and bicycles. Wellfleet uses first in, first out inventory method. Beginning inventory of the components and the finished goods. Ending inventory of the components A19, V12 and the finished goods. Unit cost of each is given, A19, B12 and for the tricycle and bicycles. This is the projected sales of tricycle and bicycles for the coming period, and it says tricycles require 2 units of A19 and 1 unit of B12, and bicycles require 2 units of A19 and 4 units of B12. And we are required to draw up the purchase budget of A19 only. So you need to start from tricycle and bicycles production budget. Take sales budget that is given as 96,000 units to be sold of tricycle and 130,000 units of bicycle. To this add the desired closing stock, which is given as 1,000 for tricycles, 900 for bicycles, and deduct the opening stock, which is 800 for tricycles and 2150 for bicycles. So this will give you the planned production or the budgeted production. So 96,000 plus 1,000 less 800 will give you 96,200. You do the same for bicycles, 130 plus 900 less 2150. It will give you 128,750. Now we just need to focus on A19. This is the planned production for tricycle and bicycle, and tricycle requires 2 units of A19 and bicycles also require 2 units of A19. So that will be the material required for production. This is not what you're going to purchase. This is the material needed for production. 192,400, 128,750 multiplied by 2, 257,500. These are A19 needed for producing tricycles and bicycles. To this we add the closing stock of A19, that is 200, and from this we deduct the opening stock 3,500. So what we have done, please note, these are A19 required for tricycle plus A19 required for bicycles. To this we add the desired closing stock of 2,000 of A19, and from this we deduct the opening stock of 319, and that should give you the answer. Once we get it, then multiply this with the rate given, and it is given as $1.2 per unit. So let us first calculate the units required to be purchased. 192,400 plus 25,700 less plus 2,000 less 3,500. So you need 448,400. 448,400 A19s are required to be purchased, each costing 1.2. Multiply this with 1.2, you should get 538,080. It perfectly matches with your option A. Question 36 requires you to calculate B12. If the economic order quantity of B12 is 70,000 units, the number of times that Wellfleet or company should purchase this component during the fiscal year ended June 30th, year 2. We will have to find out how many units of B12 do we need, and whatever the quantity is required to purchase, we'll divide that with 70,000. This will give us the number of times we need to purchase. So this again requires the setting up of production budget and then the material needed. So let us go back and extract the information we have just extracted. Now you will use this table, but in place of 2 and 2 for A19, now you will use 1 unit for tricycles B12 and 4 units for bicycles B12. So then this will give us the material needed, and we will adjust it for stocks, and then we will know what to do. So let's take a snapshot, paste it there, and do the working over there. So this is the same working we did in the previous question, but here this is what we need to produce: the number of units for tricycle, number of units of bicycles. Each tricycle requires 1 unit of B12, and each bicycle requires 4 units of B12. This will give us the total units of B12 needed for production. So it's going to be 96,200 plus 128,750 multiplied by 4. So the total quantity we need is 611,200 components of B12. To this we add the desired closing stock of B12, that is 1,800, and from this we deduct the opening stock 1,200. So plus 1,800 less 1,200 gives you 611,800. 611,800. This is the material needed to be purchased in the coming period, and every order would be of 70,000 units each. Divide this number 611,800 with 70,000. That would mean we would require the material purchase 8.74 times. That closely matches to option 9, because 8 purchases will not help. You need to go for the ninth, partial ninth, so that's going to be D. D is the right option. So last but not the least, Cart Bicycle Company has we need purchase budget. In January budget for raw materials, how many tires are expected to be purchased? Cart Bicycle Company has prepared production and raw materials budget for the next year. At the end of this year, the finished product inventory is expected to include 2,000 bicycles. That's the desired closing stock for the current period, and this will serve as the opening stock for the next period. And raw materials inventory is expected to be 3,000 bicycle tires at the end of the year. And don't forget, we are looking for Jan next month. Each finished bicycle requires 2 tires. The marketing department provided the following data from the sales budget for the first quarter. Expected sales Jan, Feb and March. The company inventory policy is to have finished goods product inventory equal to 20% of the following month's sales requirement, and that's the policy related to your finished product. And raw materials equal to 10% of the following month's production requirement. In January budget for raw material purchase, how many tires are expected to be purchased? So what you will do, you will take Jan, Feb Our planned sales, that's the starting point. You cannot write up the purchase budget without first finding what do you need to produce. Production feeds into purchase. So planned sales for Jan is 12,000 units. Planned sales for Feb is 16,000 units. Desired closing stock as per the policy, 20% of the following month's sales requirement, which means the closing stock in Jan is going to be 20% 16,000, so that's 3,200. Closing stock in Feb will be 20% of 18,000, that is 3,600. Then what is going to be the opening stock of finished good, which is already given? We have got 2,000 bicycles, so that means 12,000 plus 3,200 less 2,000 gives you 13,200. This is the production for Jan. What about production in Feb? This 3,200 closing stock of Jan is the opening stock in Feb. So 16,000 plus 3,600 less 3,200 gives you 16,400. Now, this is the planned production for Jan and Feb. Each cycle requires 2 tires, which means we would be requiring 13,200 multiplied by 2. We would require 26,400 tires in Jan, and 16,400 multiplied by 2, we would require 32,800 tires in Feb. That's the material required for production. This is not what we are going to purchase. We need to bring in the raw material policy also. Closing stock each month should be equal to 10% of the following month's production requirement. So closing stock in Jan is going to be 10% of the requirement in Feb, that's 3280. And opening stock of tires is already given to you in the question. It is 3,000 bicycle tires were already there in the opening stock. So 26,400 plus 3280 less 3,000 gives you 26680. And that perfectly matches with your option D.